and welcome to the Morningstar series Ask the Expert. I'm Emma Wall and I'm joined today by Morningstar fund analyst Fatima Kazoo. Hi Fatima.
Hi Emma.
So we are running an Emerging Markets Week this week, but it's important for investors to have a diversified portfolio. They can't just put all their eggs in one basket. So we're going to talk today about US funds, which offer diversification when you're also looking for emerging market investment. So some US funds that we perhaps rate highly here at Morningstar. What's the first one you've picked for us?
The first fund I'd like to talk about today is Dodge & Cox Worldwide US Stock Fund, and it's run by an outstanding team of 9 managers with an average tenure of 26 years, which I think is exceptional in the sector. It's a large cap value biased fund with a contrarian strike. It's very much a team-based approach, and they will often invest in what many investors will consider as unloved or controversial stocks. And they have long-term mindsets.
Does that mean that because they're investing in unloved stocks, it might be quite a volatile fund, or does that 26-year tenure mean that they know what they're doing?
No, it can be volatile, and investor here should share that long-term horizon, but also expect some periods of underperformance. And they have made some mistake in the past, but they have learned from that. And looking at the long track records, it's been strong over time. And I have applied consistently the approach here.
And that's fantastic, because I think a lot of investors think of US stocks and they think of the S&P 500. If you just want S&P 500 exposure, you should buy a tracker. However, if you want something that's going to have an opportunity for better than market returns over the long term, you've got to pick a fund manager who has a distinct style, like the ones that we're mentioning today.
Yes, exactly. US market is very efficient and it's very difficult to beat the benchmark. And funds who are benchmarked to whereas tend to struggle. So stock picking and having a different approach is very important in such markets.
With that in mind, what's the second fund today?
The second fund is the GPM US fund, and it's also managed by a highly experienced management team led by Dennis Rule. They seek to add value here through a rigorous quantitative assessment of stock, complemented by a behavioral finance overlay, which play in the strengths of the team here and has added value over time. They will select stock based on 3 factors, the usual, which are value, momentum, and quality. And when we look at the portfolio, it actually holds a mixture of growth and value stock. However, investor here should be aware that value had the highest weighting over time. And the team approach actually worked over time, but also medium term and also in different market conditions, which I think it's excellent.
It's pretty impressive, yeah. And what's the third fund today, the final fund?
The final one is Franklin US Opportunities, and it's run by an excellent fund manager, Grant Bauer, since 2009. And he has actually been with the group for more than 20 years. This is a highly growth funds, and the process is typical of a growth strategy, with the manager basically looking for companies with sustainable growth and quality balance sheet, but also which are attractively valued. So the portfolio will therefore hold a number of positions in high growth areas and will have no exposure or little exposure in sector like consumer staple, as you will expect it for a growth fund.
Because of that, though, is there a bit of volatility? Because those consumer staple stocks tend to be the sort of steady eddies, and if you don't have them in a portfolio, you can perhaps a little bit more fluctuation.
That's correct. However, if you have a good stock picking and in other areas that will compensate that, when those type of bonds yield type stocks do run in certain type of markets. What's interesting in this fund and differentiated relative to its peers is the flexibility, in my view, from which the manager benefits here, allowing him to move up and down the market, and such flexibility and the overall approach of the process has led really to strong long-term performance.
And it also means in a market like this, when many US equities look expensive, he is able to move into those areas where he sees opportunities where perhaps other fund managers couldn't.
Yeah, exactly. It gives him more freedom and it adds value over time and in different type of markets.
Fatima, thank you very much.
Thank you, Emma.
This is Emma Wall for Morningstar. Thank you for watching.